Everybody, welcome to Property, Plant, and Equipment. This is the shortened series, part 2. This is covering straight line depreciation expense. I'm the accounting professor, Bennett Tchaikovsky, copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without the prior written off permission from the author. The opinions expressed herein are those of the author only and not the author's employers and or other affiliated organizations. Okay, so when you're going through and looking at this, I generally introduce the concept of straight line depreciation when we go through and go through and do adjusting entries. Let's kind of go ahead and just kind of review this right over here. When we're depreciating, we have a couple different rules. We can only record depreciation up to the salvage value. What does that mean? The net book value, which is the asset or the equipment minus the accumulated depreciation, that net book value can never go below the salvage value. Even if we're continuing to use the equipment, we have a limitation in terms of how much we can kind of go through and depreciate. And again, this is for we depreciate assets. This is how we show the use of the asset. We're recording the expense. So when we do straight line, we're going to need to know what the acquisition cost is. Covered that in the earlier videos. What is the salvage value? Meaning, what is the best guess estimate in terms of how much we're going to receive when the asset is disposed of? How do we figure this out? You do the online research. Generally, when companies are going through and recording depreciation expense, they have to come up with this estimate. And again, it depends on the type of asset that it is. Probably the best thing to do is to use online resources and then basically take screenshots in case an auditor or somebody else comes back later wanting to know, well, how'd you come up with this number? Last one is the estimated useful life, or how long the asset will last for. Again, you can kind of go through and do look at different tables. If you have a certain type of vehicle, like if you said to me, well, Bennett, my Mercedes S-Class is going to last for 300 years, I would probably ask, is it April 20th today? But in all seriousness, you just have to use something that's going to be somewhat reasonable. Now, why do we choose straight line? And what this really means is that the depreciation period over period, month by month, is going to be relatively the same. Well, there's an assumption here that the dollar amount, when I add up, like if we kind of think about the cost of an asset, it's really the depreciation, which I'm writing off the cost, plus the maintenance. And if the maintenance is going to be relatively smooth over a period of time, and the amount that we're going to be spending is relatively smooth over a period of time, then it kind of makes sense to use a straight line methodology. This is opposed to other types of items which have a lot of maintenance later on in their assets' lives, such as BM trouble use. But we're going to talk about that later when we get to the ultimate depreciating machine, Break My Wallet, Bavarian Meat Wagon, when we get over to double declining balance. But for right now, straight line, taking the same amount of depreciation expense every, each month, day, year, it's going to depend on how many months out of the year we use the assets. So how do we compute straight line? It's going to be the acquisition cost minus the salvage value, right? We can't depreciate beyond that amount, divided by the estimated useful life. This gives us an annual depreciation expense. Now, when we record depreciation expense, we're going to do it very specifically. We always do this no matter what method. I debit the expense and I'm crediting not the asset itself, but a contra asset account. It's called accumulated depreciation. It's a contra asset because it's going to reduce the carrying value of the equipment. And what's very important here, this is not going to be closed out to retain earnings like depreciation expense will be, because that indicates how long we used it for during the period. Rather, we're going to accumulate that depreciation expense over time. And we're going to do this through a comprehensive example. So let's go ahead and go to our example. So right over here on April 1st, 2028, we purchased equipment for $400,000. The installation expenses were $50,000 and the shipping expenses were $30,000. The salvage value of the equipment is $120,000 and the estimated useful life of the equipment is 3 years required using straight line depreciation. Calculate depreciation expense for the years ended December 31st, 2028, 2029, 2012-31-30. Prepare the balance sheet section, and then the journal entry to record the expense. So let's kind of go through and do this first. Like, so when we bought the equipment, and we're just going to make the assumption that we went over here and we paid cash for it, right? So when I go over here and I'm going ahead and debiting the equipment, and I'm going to debit the equipment for the amount of the acquisition cost, right? So my acquisition cost for this equipment is going to be what? Well, it's going to be 400,000 plus installation, which is 50,000 plus 30,000, which is shipping, for a total of 480,000. Remember, acquisition costs per the earlier video are all the costs we're going to go through and spend to get the asset ready for its use. This includes shipping the item to our facility to go through and getting it up and running. Now, the first thing we want to go through and do when we get this, so I would typically debit equipment, and assuming I paid cash for all those other items, I'm going to credit cash for over here for 480,000. Now, assuming that I've gone through and done that, and that was going to be on April 1st, 28. Now, to compute annual depreciation expense, what do? Well, I'm going to come over here and I'm going to say my acquisition cost minus my salvage value divided by my estimated useful life. So my acquisition cost, I'm flickering today. My acquisition cost is 480,000. My salvage value, it says right over here, was 120,000. And this is going to be divided by my estimated useful life of 3 years. So another way of writing this is 360 divided by 3, or this $120,000, right? I'm just dropping the zeros, getting with the hero. This $120,000 is going to be my annual depreciation expense. This is how much I would be going through and recording every single year. So this is my annual depreciation under straight line. So now we get over here to how do I go through and record depreciation expense? Well, if we remember from our famous T account, we've got assets equals liabilities plus my owner's equity, ER, DC, right? You can watch this on other videos I've made. I generally, with expenses, which is the E, I'm going to record those with a debit. So over here, I'm going to debit depreciation expense. And as we saw earlier, I do not credit the equipment directly. Rather, I'm going to credit accumulated depreciation on the equipment. Okay, so right over here, we've got a debit to depreciation expense, credit to accumulated depreciation on equipment. Now, the question becomes here on 12/31/28, do I record the full 120,000? No. The problem is that 120,000, this is estimated useful life, is 3 years, right? This is 3 years. So if it's 3 years, this is per year. How long did I go through and use it for? Well, in this first year, I used it for a total of April, May, June, July, August, September, October, November, and then December. Right, so I used it for a total of 1, 2, 3, 4, 5, 6, 7, 8, 9. I used it for a total of 9 months. So what I'm going to do here is I'm going to take the annual depreciation expense of 120,000. And this is what I computed up above. I'm going to go ahead and multiply that by 9/12, right? And this is going to give me $90,000. So the amount of depreciation expense I'm going to go through and record for the first year is going to be this $90,000. And this is usually where students will mess up. They'll calculate the annual correct, but then they'll forget, oh, this is a partial period because I bought it on April Fool's Day. So over here, this is what I need to do. And whenever we're going through and recording it, this is how we go through and do it. Okay, now, so if I'm being asked to do a journal entry, I can just simply go over here and say, okay, I'm debiting depreciation expense. I'm going to credit accumulated depreciation on equipment. And then over here, this is going to be 90,000 and 90,000, right? And I'm just going to put this over here. This is going to be my debit credit, and this will be as of on 12/31/28. The last thing I need with my journal entry is I also have to go through and say, well, what is this for? This is going to be to record depreciation expense. Okay, so this is what happens. So over here, when I'm being asked to go through, and so I basically computed depreciation expense for 12/31/28. Let's go ahead and do these other parts over here, and then we'll kind of circle back and do the other ones over here. But what does the balance sheet look like? What is the balance sheet presentation going to look like for this particular equipment? So remember, when we're doing a balance sheet, right, we're going to say over here, the company name, this is YYZ, balance sheet as of. And when we're doing our balance sheet, we're going to have assets and we're going to have non-current assets, right? Because this is where equipment's going to go. We're going to have over here, whenever equipment less accumulated depreciation on equipment is going to give us equipment net. Now, one of the reasons why I asked you to go through, and I'm having you do this, basically for what periods of time, I want to know basically over here as of 4/1/28, 12/31/28, 12/31/29, 12/31/30, and then 12/31/31, and then also 12/31/32. So we're really kind of going out and having some fun with this. Okay. So we've got this over here. Okay. Now, when we first bought the equipment, right, I paid $480,000 for it. Was there any accumulated depreciation at that point? And the answer is going to be no, because we haven't started using the asset yet, right? We've got to use that asset first. So my equipment net value is going to be $480,000. By the end of the year, though, what did we just do? Well, over here, we've got equipment at 480, right? We're not going to mess around with this, but we have accumulated depreciation on equipment. We're going to subtract that from this balance over here because, again, it is a contra asset account, right? This depreciation expense, what happens to it? This is going to get closed out to retained earnings, right? That's what's going to happen with that. But this accumulated depreciation, this is going to be accumulating the depreciation on the equipment. Okay. So what's going to happen basically over here for the next year? Well, over here in 2019, right? So my depreciation expense, and we can just go ahead and use these same accounts. Okay, so on 1/1/19, this is going to have a zero beginning balance. Why does it have a zero beginning balance? Because remember, our expenses, revenues, and dividends all get closed out to retained earnings. But my accumulated depreciation on equipment balance, this balance is going to carry over from the prior period, right? Because this doesn't get closed out. We do not close out assets, contra assets, liability, contra liability accounts to retained earnings. Rather, what we're going to go ahead and do is we're going to basically carry forward the balances. So this is going to have a beginning balance of 90,000. Okay, so now that we have this part over here, okay, so my next part over here is that how much depreciation do I record for the year 12/31/19? Well, I used it for the entire year, right? This is a 3-year asset. I used it for the entire year. So I'm going to record depreciation expense of 120,000. So my total depreciation expense for the year is going to be 120,000, right? Once I compute it, the annual amount, it doesn't change. It's straight line. So over here, my accumulated depreciation on equipment is going to be 120, because remember, when I'm going through and doing this journal entry, right, the journal entry does not change, right? This is going to be 12/31/29. And over here, debit depreciation expense, credit accumulated depreciation on equipment, except I used it for the full year. So I'm going to go ahead and just write in that 120,000. So my accumulated depreciation on equipment is going to be that 90,000 beginning balance plus what I did during the year. So my ending balance here is going to be 210,000. Now, 12/31/29, my balance sheet presentation, my accumulated depreciation is no longer, it is 90,000. It's also going now, it's going to be 210,000. So my equipment net is going to be 270,000. Whenever we're looking at this number, we can have to make sure that this equipment net never drops below 120,000. I can never go below my salvage value. Okay, let's go ahead and take a look at the next year. So for 12/31/30, what is going to happen? Well, what's going to happen is right over here, maybe don't need all this, these extra lines. And let's go over here and make this a little bit more compact. Let's do this. The magic behind the scenes is always fun. Okay. Okay, so we're now going to be on year 3, right? So the depreciation expense as of 1/1/20, this is going to be 0 because that amount is going to be closed out. But on 1/1/20, what is the balance on accumulated depreciation on the equipment? Well, I'm going to carry forward that prior balance of 210,000. How much do I record this year? Well, I use the equipment for an entire year, right? So it's straight line, right? I'm going to basically go through and record another 120,000. Now I only need to do the journal entries for these 2 years. So it's just going to be another 120,000. We'll do it on T account. So 12/31, God, Bennett. Let's go ahead. 1/1/29, 12/31/29. This is what happens when you go into the future, right? Serious repercussions. 12/31/29, and this is going to be, dare we say, 1/1/30? 1/1/30. Wow. Okay, so during this year, I record 120,000 credit accumulated depreciation on equipment for 120. So over here, my accumulated depreciation balance now has a balance of 330,000. So over here, this is 12/31/30. So I record the depreciation expense, credit accumulated depreciation on the equipment. I'm going to come over here, and so my accumulated depreciation balance is now 330,000. When I go up here and add this, I now have 150. Let's remind ourselves, the salvage value is 120,000, right? So when we get to 12/31/31, okay, if I kept on doing what I was doing, right over here, what would be happening would be, well, my 1/1/31 balance here is 0. And if I took a full year of depreciation of 120, what's going to happen? Well, my 1/1/31 balance right over here is going to be 330. This balance would now be 450. And if I come over here and look at this and say, okay, I've got 480. And if I subtract right over here, this 330, I'm now in a lot of, actually, it's not 330. It's gonna be 450, excuse me. I now have equipment net of 30,000. I can't do this. What's happened? I have over depreciated the asset. Now, when we get into this kind of a scenario, right? How many months of depreciation have I taken? Well, if I think about it, right, the months to depreciate, this had a 3-year life. Or 12 months in a year times 3 years is going to be a total of 36 months. Okay, so how much did I depreciate during this first year? Well, I only used it from April 1st through December 31st, so it's going to be 9 months. The second year, I used it over here for 12 months. Third year, I used it for 12. When I look at this over here, the most I can take, right, because these numbers have to add up to 36. I can only take 3 months, right? Because over here, and really what I'm doing is, this is what I did in the first year, right? So this was in 2028. And in 2029, I took a full year. In 2030, I took a full year. In 2031, I can only take a total of 3 years, and I've already, used 2 years and 9 months. So that's basically going to leave me with January, February, and March. Okay, so right over here of 2031. So it's going to be January, February, and March. right? Because in total, I can only take 3 years of depreciation expense. So if I go through and do that right over here, if I say, okay, if I take 120,000, and I multiply this by 3/12, what I'm going to get is I'm going to get $30,000. So the amount of depreciation expense that I take is going to be 30 grand, basically over here for this year. When I do this, if I take in this for this very last year, if I only depreciate it by 3 months, look what happens. My ending equipment value over here is my salvage value, and I have to stop. Even if I'm continuing to use the equipment, I can never go beyond salvage value in terms of my net book value. This is something that's very, very important to go through and remember as you're doing these types of questions, right? So what happens in 12/31/32? Well, I still going to be the same equipment. If I'm still using it, I can't take it off of my books. But over here, my accumulated depreciation is just going to stay the same. I don't depreciate the asset anymore. Once I reach salvage value, I have to stop depreciating the asset. So again, let's kind of go back through and just kind of take a look at this question, right? So the first part is determine the acquisition cost, right? Acquisition cost minus the salvage value. The salvage value is 120. I cannot depreciate that part. My estimated useful life is 3 years. I came up with 120,000 annual depreciation expense. But because I bought it on April 1st, right? I only used it for 9 months that first year. So the amount of depreciation expense I'm going to record for the first year is going to be 9/12 times 120, or 90,000, right? So that's what I went through and did. And as we go through and look at this, right, we recorded the same amount for 2029 and 2030. And all this time, right, what's happening with the expense will just get closed out to retain earnings. This is a contra asset account, though, this accumulated depreciation, because it brings down the carrying value of the equipment over here. And then by that very last period of time, it ends up being at 120, which is the salvage value. And if I continue to use the equipment, I just keep on leaving it on the books, but I don't depreciate it anymore. Okay, so that's kind of how this part of it works. And then again, for the journal entries, the format is never going to change. It's always going to be a debit to depreciation expense and a credit to accumulated depreciation on equipment. So that kind of wraps it up here for straight line, right? So those are just some things to kind of go through and consider as you're going through and doing this question. And in any event, I look forward to seeing you on the next video. Thank you for being here with me today. And I keep on fading to black. I don't know what's going on here. Maybe I can come back, maybe not, maybe so. I don't know. Thank you so much for being with me here today. If you have any questions, please feel free to leave those questions below. And I look forward to seeing you on the next video. Have a great day.